Bloomberg Audio Studios. Podcasts, radio, news.
Hello, it's Merryn Somerset Webb here. For our last show of this season, sorry about that, before we go on a short hiatus for the summer, I speak with McDonald, author of How to Listen When Markets Speak, Risks, Myths, and Investment Opportunities in a Radically Reshaped Economy. In the book, Lawrence discusses the predictive model that he developed in the aftermath of Lehman Brothers' collapse, outlining actionable trading ideas for a radically reshaped economy. We discuss some of those ideas in our conversation. You're going to enjoy it, so hang on for that. But first, as always, senior reporter and author of Money Distilled newsletter, John Stabik is with me. John.
Merryn.
Before we really start, congratulations. Like this podcast, Money Distilled, your incredible newsletter, can now be called award-winning. So we now have an award-winning podcast and an award-winning Money Distilled newsletter.
Yes. So I hope you're all grateful. Still free.
No one's ever grateful enough, John. Both these award-winning things are 100% free. Now listen, tell me, John, what makes your award-winning newsletter, Money Distilled, so incredible?
Well, I think it's just a combination of the kind of wit and the excellent writing and the.
Do you know, for those of you who don't understand Scottish accents, he said wit, not wet.
I'm calling HR. I've had enough of this hostile environment.
They never call back.
It's because they don't understand my accent. What's that guy complaining about?
I'll tell you why I think your newsletter is so brilliant. It's extremely well written. You're unbelievably knowledgeable. You are witty, quite clever, and you take big things that happen in the markets, in economy and in personal finance, and you translate them into really straightforward language with actionable points at the end. It's absolutely brilliant. If you're not reading it, everybody, you should be reading it. And of course it is award-winning.
Well, thank you very much, Merryn, for acting as my translator there. That was good.
Right, so, well, I am a truth teller. Now, the last couple of days haven't been great for markets. We should talk about that a bit because we have been telling everybody for ages that they want to be really careful with big tech, really careful with growth. They want to worry a lot about the high level of concentration in the US market, and they want to make sure that they are properly diversified. And of course, holding a passive fund exposed to either global markets or to US markets has been quite dangerous because it gives you a very concentrated portfolio. Those big tech companies make up a big part of every single index. Been dangerous, we've been worried, and now we've started to see those tech stocks come off quite fast, although irritatingly other markets will insist on following. So the Nikkei, super irritating. You know, America goes down, big tech goes down. What does Tokyo do? Follow. So irritating. Anyway, I wasn't going to ramble, I was going to let you talk. John, it happened.
It happened. Well, actually, I was going to leave most of this one to you because obviously it is entirely your fault because you published a column yesterday talking about bubbles and pointing out that AI was obviously a bubble. And then all of a sudden we have this big market crash. I mean, you've inflicted literal financial violence on the entire global stock market. I hope you're proud of yourself, Merryn.
You're right, it is literal violence. I am proud of myself. I am. You know, that someone has to be the voice of common sense, John. And when you look at what's been happening in the AI stocks, and particularly in some of those big ones, of course it's a bubble. And everyone will say, well, it's not because of this, it's not a bubble because of that, it's this, it's that, and oh, look, it hasn't collapsed yet, therefore it's not a bubble. Of course it's a bubble. Well, it's got all the characteristics of a bubble. And it made me think, actually, when I was writing a column about this, as you said, and I'm afraid it was edited out, but I started it with a nice list of all my favourite bubbles, because I feel like everyone who works in finance at all should have a bubble that really talks to them. And for me, it's the great diving bell bubble, which if you go and look it up online, you'll find some of my columns on it. I think it's the most fascinating bubble. And then a friend, Edward Chancellor, was telling me the other day that his favourite bubble is the great Taiwanese market bubble, 1980s. I didn't know that one very well, so that was new to me. And I've always been very fond of the Beanie Baby bubble.
That was a good one.
That was an absolute stormer. Do you have a favourite bubble, John?
Well, you know, it's kind of like asking, do you have a favourite child, really, isn't it? I mean, no, the diving bubble is one that I learned from you, and that was a good one. But I think, actually, the favourite bubble is probably actually the one leading up to 2008. Because it was such a kind of weird bubble and also such a catastrophic bubble. I mean, one nice thing about normal bubbles, for want of a better word, like stock market bubbles, is that the amount of damage they do is usually not widespread in terms of the whole economy. Whereas the difference with that in the 2008, or rather 2006, 2007 bubble was that it was, a financial bubble, and that just shuts everything down for ages, which is why we've had crap growth for so long, even though no one acknowledges it.
Well, you're right. And the consequences of that bubble were longer lasting and deeper than any other bubble I can think of. And we're still living with the consequences of them now, which, by the way, is part of what Lawrence's book is about. It's about the debt bubble that has grown up since then, the consequences of it and what happens as a result. It's about inflation. He agrees with us on inflation, so that's quite nice. A little bit of confirmation bias from him. And there's a lot in there as well about the things we've talked about, the massive concentration in the US market in tech stocks, etc., and how dangerous that is. So he's probably feeling a little vindicated this morning as well.
One thing I did want to ask, or I guess maybe point out, was, I mean, you're right, one of the frustrating things about all this is that the US market has shot up an awful lot, and all the other markets have gone up a little bit. And now the US market falls off, all the other markets fall off too. And I think that can leave investors, particularly the kind of value investors, feeling a bit aggrieved. But I think the important thing to remember is that the US has outperformed other markets for the best part of like 10, 15 years now. But it's not always the case. So you got to expect a period of underperformance for the US. And I think that although on a day-to-day basis it kind of looks as if the US is pulling everyone around, assuming that this is it, I suspect that in 5-10 years' time, you will have been better off putting your money in the rest of the world, or, the non-tech stock bit.
You'll begin to see the separation. Everything may follow the US down in the beginning, but over time it'll shake out. And it is worth remembering one of the things I said in the column I wrote yesterday, which is that over the long term being in the US from 1926, it's a matter of how much data we can get our hands on. Over the long term, value investing has outperformed growth investing by a couple of percentage points a year, which adds up to real money over time. Obviously, the last 20 years has been unusual, but that's the long-term trend, and you can expect, usually, things to revert to some kind of mean over the very long time. As I used in that, there was an astronaut, US astronaut a decade ago, who said that on his first spacewalk, he realized that he'd always thought he'd been frightened of heights, but in fact what he was frightened of was gravity, which I think is wonderful, and of course absolutely true. And, of course, the less far you have to fall, the less it's going to hurt. So being at a time like this in stocks that are less expensive in valuation terms is probably going to be less painful than having in a portfolio that is extremely concentrated into big tech.
Yeah, I think that's a good point.
I mean, it's simplistic, but seems likely.
Yeah, and because otherwise what we're saying is your choice as an investor is NVIDIA or cash. And that can't be right. It's like, the other stuff will come good over time. So I wouldn't worry about it too much.
Yeah. Anyway, we talk about this quite a lot in the podcast. We talk about NVIDIA. We talk about how we talk about the energy markets. We talk about what might happen next. So let's move on to that. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb. Here's my conversation with Lawrence McDonald, author of How to Listen to When Markets Speak, Risks, Myths and Investment Opportunities in a Radically Reshaped Economy. Larry, thank you so much for joining us today.
Oh, it's great to be here. Thank you.
Larry, can we just start by you telling me a little bit about the great sweep of history that you talk about in the book, that the next 40 years is going to be very different to the last 40 years. What's the big change here? What's given us this radically reshaped economic landscape, as you put it in the book?
We start off in the book in Abu Dhabi. I delivered a speech there, and I sat down with James Baker. This is several years back. And James Baker was the former Treasury Secretary, kind of a quite brilliant historian. He made the point that we're going from a unipolar world over to a multipolar world. And what does that mean? It reminds historians of, say, from 1968 to 1981. Right? So from 1968 to 81, the world was more unstable because we didn't have a key superpower. We had more global conflicts. Supply chains were very, very disrupted. In some cases, we had protectionism, a lot of the same trends that are coming at us today. What I learned in Abu Dhabi, sitting down with James Baker, is around what it's like to actually construct a portfolio in that period versus the period that we're in now, or the period that we've been in for like the last 15 years. And so in a 1968 to 81 portfolio, you've got more sustained inflation, you've got more global conflict. So the portfolio allocation more toward value and hard assets. To give you an example, in 1980, 81, 49% of the S&P was in industrials, materials, and energy. And as of like 9 months ago, this number got down to 12, 13%. So that's what we're talking about, a radically reshaped economy where you've got more sustained inflation, potentially much higher levels of protectionism, and that sets up for a whole new portfolio construction.
So we expect the sustained inflation to come from the fact that we live in a world of geopolitical tension, one where supply chains are more difficult. You have to pay more for your security. You have to take circuitous routes. You have protectionism in place. Maybe fuel is more expensive. So supply chains in general become more unstable and more expensive, and that feeds directly into inflation. And then on top of that, you will have the changing power of labor. I think you talk about this in the book, power of labor across the West, and so possibly fast rising wages, which will feed into inflation. And then on top of that, you have something that I know you talk about a lot, which is rising energy prices. Is that right? So we have all these things feeding into a higher inflationary environment.
Yes, and then there's two other things. So Barack Obama was probably the most brilliant politician and just, on his feet, great thinker. He told us in like 2012 election rate with Romney that those jobs aren't coming back. So both Republicans and Democrats took 5 million jobs out of the United States the last 30, 35 years.
By encouraging outsourcing, you mean?
Yes. In other words, again, globalization, it has a lot of disinflationary benefits, right? All of our underwear was made in the United States in 1960, right? And most of the things that we live and breathe and consume every day went from, being made in the United States pretty much to over 40 years being made around the world. And so the supply chains that you need have to be very, very, very efficient in that, because we swung so far to the other side. But the most important thing goes back to my first book. So the fiscal and monetary response to Lehman, which is the great financial crisis of 2008, the fiscal and monetary response was $4 trillion in the follow-on, say 3, 4, 5 years after. $4 trillion of fiscal and monetary. And that's fiscal spending, and that's what the Fed pulls off in terms of accommodation. The fiscal and monetary response to COVID, plus Silicon Valley Bank and Signature Bank and New York Community Bank, that's about 16 trillion now. So we've gone from 4 to 16. So we've done this, fiscal overdose from Trump and Biden. I'm not pointing any fingers at any party, but it's quite extreme. And that amount of fiscal juice, it makes it very difficult for the Fed to bring down inflation and to in a sustained manner.
Right. Okay. All right, Lawrence. Right. So let's talk then a bit about and we mentioned how inflation is fueling more labor power, and how we've been seeing unions making wins in the UK and the US across the place, and we're seeing rising public sector wages, etc. Now that all feeds into inflation. But the thing that I really wanted to talk about was your views on energy and how, and you've got several fun-sounding chapters on this. Fossil fuels paving the way to the green meadow, or not. Maybe we'll find out. Now, you think that we've been massively underinvesting in fossil fuels in our energy infrastructure, and also our kind of increasingly dodgy relationships with obviously Russia, but also Saudi Arabia are not helpful here.
Yes. So let's get to some very simple statistics. First of all, in terms of investment. So in 2014 to 2024, the global population is about almost 1 billion people more. It's like 900 million. So you're almost up 1 billion human beings from 2014 to 2024. Now, if you look at the trajectory from 2010 to 2014 in capital investment in oil and gas, metals, materials, uranium, key energy producing materials and obviously fossil fuels. The investment track from 2010 to 2014, if you took that forward to today and you look at where we are, we're essentially $3 trillion behind that pace. And with a population that's up almost another billion people. And so we meant well. We took 5 million jobs out of the United States. But at the end of the day, we raised the standard of living in India and the emerging markets world dramatically. So we've created a whole new class of carbon consumers. I mean, if you work in a call center in India, you're making 100, maybe 50 times more than your great grandparents. And so now we're creating this carbon consumer class globally, even though the developed world has pulled we were underestimating that kind of demand from that developing world. And at the same time, we've suppressed the investments on oil and gas and metals and all the strategic investments that you need to fund or to sustain the planet.
Okay, so do you anticipate an energy shortage in the next couple of years?
Yeah, it's anywhere from 12 months to 36 months out there. But when you talk so we run a Bloomberg chat, like I said, with all institutional investors. You talk with people in the energy space. You talk to different institutional investors, that are looking with portfolios that are constructed for 5 years out, 10 years out. And that's the big thing is that's the big bet is that what we think is the smart money is betting on a move back toward a different portfolio for a different type of decade, like energy shortage, material shortage. Let me give you another example. The NASDAQ 100 now, within the last month or so, was worth $24 trillion. And the energy sector was worth $3 trillion. So it's 21 trillion bigger. And in 2014, this number was 600 billion. So you've gone from 600 billion larger to 21 trillion larger. And so the entire portfolio construction of all the wealth and all the 401ks is so egregiously weighted toward what we call financial assets, which are stocks, growth stocks, and bonds. Whereas hard assets and Bitcoin and things like that, the amount of money that's in hard assets, and that includes like oil and gas companies, that includes companies like Alcoa, that includes companies like Rio Tinto, the amount of money is just so skewed the other way. And so we're coming to a period in the next 5 to 10 years where potentially $20 to $30 trillion leaves that crowded trade and goes into everything else.
What makes it leave that crowded trade? And we've seen this actually as we speak, right? The US tech stocks have not had a good couple of weeks. So we're seeing that happening already. What's the impetus for this?
Well, there's a couple things. Inflation's come down over the last year, and Powell and the Fed governors have really cheered it along, which that's fine. They want to cheer it along. And so they've got everybody convinced that inflation is going to come back to the 1-2% range. And that's where tech stocks did great from 2010 to 2020. But in our book and in our research, we went back over 2,000 years and 3,000 years of different civilizations on Earth. And you go back, and a civilization at 3% inflation is a very problematic if it's sustained at 3 to 4%. There's a very unlikely sustainability of over a longer period of time if inflation stays there. And so that's why the Fed governors, and that's why there's so much. If you look at every Fed speech and every Fed meeting, they always use these words: long-term inflation expectations remain well anchored. I mean, they say it every single Fed meeting. And the reason is that's why the inflation standard of 2%, that target, is part of the Fed mandate. It's because that's how dangerous inflation is to a civilization. And so there's been a psychology around this move down in inflation that has gotten everybody very comfortable with going back into tech stocks. But the net present value of all future cash flows, like think about investing in tech stocks, the net present value of all future cash flows is worth a lot less if inflation's normalizing 3-4% versus say 1-2. And so what happens is, that's why from 1968 to 81, in that period, that's why the composition of the S&P ended up so heavy on industrials, oil and gas, and materials, is because once you have a sustained inflation for more than like 3, 4, 5 years, the psychology flips where people want to own companies that control assets, right? That control like this. What think of the assets that Rio Tinto controls, right? Think of the assets that say Antero Gas or Southwestern Energy or any of these companies that control land and assets. In an inflationary world, those assets protect an investor from inflation, whereas a company that's sitting on a lot of cash or a lot of intellectual property, which is wonderful, like a tech company, they're not protected so much against just long-term sustained inflation.
Yeah, no, I see that. Now, one of the things that I always find amazing when we have this conversation about the percentage of the US market that is now tech and the percentage that is energy is that there's almost every sector is dependent on energy, but it's extraordinary as we learn more and more about how much energy, for example, AI will use. So lots of those tech companies are dependent for their existence on the energy companies that have been so shunned.
That's it. I mean, you just nailed it. I mean, this happens in every single cycle of mania, is there's too much attention on the NVIDIAs of the world, the super microcomputers, the microns, and they mean well. I mean, Wall Street strategists mean well, but they're just not doing the math, because if you believe NVIDIA's estimates in terms of what they're telling Wall Street, we're going to need a new power grid in the United States, right, which is going to cost $2 trillion. We're going to need a lot more copper. We're going to need a lot more energy infrastructure in terms of companies that actually move electricity around. Like how is that electricity transported? Aluminum, things like that. And then if you take all those electric vehicles that are in the agenda for the green economy, and you also put those on the power grid, it creates even more and more stress. So it's just a crazy, crazy moment historically where everybody's focusing on, one thing. Everybody's focused on like 1999. Everybody's focused on JDS Uniphase and Global Crossing, but nobody was looking at Match.com. You know what I mean? Nobody was looking at the Facebooks of the world that didn't exist, or the Googles of the world. Everybody was just looking at, kind of like one part of the trade.
So from an investing point of view, it sounds to me like you would advise, but don't let me put words in your mouth, people to be moving out of growth, moving out of tech, and moving into anything to do with energy production, the revamping of the grids, not just in the US, of course, we need this very badly in the UK and across Europe as well, and hard assets, by which I think it sounds like you mean, uranium, cobalt, lithium, copper, aluminium, etc.
Yes, I mean, that's a very good way to put it. You could also just look at your value stocks versus your growth stocks, or your, say, the Russell 2000 value versus growth. These are all at really crazy, crazy extremes. The Dow Jones Industrial Average versus the QQQs. That's simple. Now, that the industrials aren't traditional value anymore, but there's a lot of value components to them. But the capitulation signal that we received at the end of June, we have a model that measures capitulation. Is this a category 1 hurricane or a category 5? And so we received at the end of June a category 5 hurricane in terms of growth versus value, in terms of Dow Jones Industrial Average versus the NASDAQ, or just Russell 2000, Russell value versus growth. All these things gave us a signal that we're heading forward a really tectonic plate type shifts.
Okay, so when we've been talking on this podcast for a long time now about how Values Day is coming again, and about, in fact, I even wrote a column about it this week again, about how over the very long term, we can see it in all the long-term studies that value outperforms growth by a couple of percentage points every year over the very long term, as far back as we have data, obviously, which is only into the 20s, of course. But the last 20 years plus have been something of an anomaly. We keep expecting value to come back, but it never actually quite does. But you think that turn is now here?
Well, okay, so you're 100% right. So think about what you just said. What happened the last 20 years? Disinflation. What happened the last 20 years? We had beautiful sea lanes, right? Trade trade and transport of goods was so easy. It was the easiest in our lifetimes. We had no protectionism to speak of, right? And the power of labor unions was decimated, right? So all those things have changed. Now, remember, after COVID, from 21 to 22, value destroyed growth, right? So that was what I call the tremor. Everybody thought that was it. Then the Fed hiked rates, 500 basis points in 18 months. And it brought down inflation, and it got everybody sucked in to the same old stale 2020 to 2010 to 2020 portfolio. And what we're saying is that actually value is outperforming growth since 2020 in some spots. Like if you look at but it's not, like you said, it's not over the last, but right now, because of that threat of sustained inflation, once the Fed cuts rates every time the Fed moves toward easing, the dollar starts to weaken, and then we start to get this move, back toward hard assets again and value. And so you're absolutely right. It hasn't worked over the last year, but it really worked well, 2021 to 22.
Is crypto basically the more a growth stock? I mean, it's not a growth stock, but you see what I mean? It tends to track growth, tends to track what happens in big tech. And we talk to people a lot who can't see a reason why Bitcoin in particular won't be a massive long-term success. I was trying to say to people, what would make this not work for you? But for people who are really obsessive about Bitcoin, there's nothing that could make it not work.
So in our book, we're very friendly to Bitcoin, because what annoys me, though, is that the evangelists and the Michael Saylors of the world, they pitch this story that is true over the long haul. In other words, the fiat currency, deficits, irresponsible government spending, the whole thing. My entire book's pitch is pro-crypto. It's philosophically. But what these people don't tell investors, and it's relatively disgusting to me, is that what's happened in the early stages of Bitcoin since 2017, when you're long Bitcoin, all you're long is liquidity. So all of this philosophy, around, let's think about the deficit. The deficits have gone from, $400 billion a year under President Obama to $3 trillion a year consistently under Biden and Trump, right? So we've had all this irresponsibility, and where is Bitcoin the last 2 years versus inflation? It's been destroyed, right? And so the point is that every single time the VIX has moved above, say, 30, every big drawdown, Bitcoin's been down in anywhere from a 10% drawdown to a 70% drawdown. So what's happening is it's essentially a liquidity trade. So if liquidity in the market starts to evaporate, Bitcoin gets destroyed regardless of its long-term story. Now, eventually that long-term story will pay off. But what happens is, imagine you're like a 23-year-old kid or a 30-year-old woman, and you buy Bitcoin with this great philosophy. And then you've got 4 drawdowns since 2017, 18 of literally 50 to 80%. I mean, gold's biggest drawdown the last decade since Lehman, gold's biggest drawdown is 21, 22%. You know what I mean? That's a store of value, right? Not something that drops every couple of years by 50 to 70%, because at the end of the day, when you're long Bitcoin, you're long liquidity. So if liquidity drives up, if there's higher volatility in the market, and here's the evil thing, when you're long Bitcoin, you're actually short the VIX, right? Nobody will tell you this. If you look at the VIX. VIX surges, look at performance of Bitcoin. All I know is I have 7 years of evidence. It's right there for everyone to see. But, what they do is at the lows, there's crickets. The evangelist cannot be found. On every single time Bitcoin's in a 70% drawdown, there's crickets. Every time it's up at these levels, where crypto was, maybe 2 months ago, the Tom Lees of the world are talking about $150,000 Bitcoin. You couldn't find Tom Lee on Bitcoin, with the lows.
So, Larry, if I were to ask you to make a choice between holding gold or holding Bitcoin over a 10-year period, I think I can guess your answer.
So the Bitcoin to gold ratio, every time it's been between 7 to 19, the last, this goes back over a decade, you want to be selling your gold and buying some Bitcoin, right? And every time the ratio is between 28 to 36, which is where it's been the last couple of months, you want to be selling Bitcoin and buying some gold. So we're by no means Bitcoin enemies. I believe in the Bitcoin story. What just drives me crazy is that people won't tell you that they'll pitch you this beautiful story about fiat currency protection, but they won't tell you that you're really just long liquidity.
Okay, interesting. Right now, Larry, I've taken up a lot of your time. So what I want to do now is just give you an open question. Is there anything that we haven't talked about that you think retail investors should be thinking about? Should they, for example, be going off and buying into Chinese equities because they're particularly cheap now? Should they be focusing only on UK small caps because there's value there? Is there somewhere in Europe they should be looking? Is there a sector in the US we haven't talked about that we should be thinking about?
Well, something that people are talking about today in our chat with the institutional investors is if Kamala gets a nice bounce, which she should get here, the solar names are going to do really well. And if you look today, the NASDAQ's off 3%, which is it's very unusual. We've had 3% drops now in 2 weeks. So that's a very, very unusual thing, considering we didn't have one for at least, I think, 9 or 10 months before that.
It fits to the signals you saw at the end of June, though.
Yes, but the point is that if Kamala gets a bounce and say she brings on a running mate that improves the ticket, the solar names, the TAN ETF, your Enphases, there's a whole number of them in the TAN ETF, but those could get a nice bounce here. Cannabis as well. So those are kind of your Kamala trades.
If the solar programs everywhere are expanded, then obviously everyone wants to be looking more closely at rare earth metals.
Yes, rare earth metals right now are screaming by. That they've been destroyed. Yeah, that's thank you for bringing that up. The rare earth REMX, I think it is. That has been that ETF is similar around that type of trade, and that's what you want to be looking at in terms of Trump trades. The big winners are going to be natural gas companies that benefit from deregulation in LNG, right? Which is, and so there's a number of Canadian natural gas companies that are extremely cheap. You get Tourmalines of the world. These things have been really beaten up. And then your exploration companies and your service companies like Schlumberger probably double under Trump. And so that's what I'm seeing. Professional investors that are taking a view on the election because the parties are very extreme now because, obviously Kamala, if you look at her record, she's way to the left of Biden, right? Just you look at her voting record. And whereas you look at Trump and J.D. Vance, this is pretty crazy. So it's so you're going to have different portfolio outcomes, dramatically different.
Okay, so we need to do a little bit of waiting and seeing how it pans out from here before we make those big decisions. Brilliant. Larry, I will let you go, but that was all absolutely fascinating. Thank you so much for joining us today.
It was a lot of fun, and give my best to the team. We appreciate everything.
Thanks for listening to this week's Merryn Talks Money. We'll be back towards the end of August, but keep an eye on the feed as we always drop in some goodies from the team at Bloomberg from time to time when we're off. In the meantime, if you like our show, rate, review and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net, particularly your personal finance questions, so we can answer them in our Merryn Talks Your Money series when we return. This episode was hosted by me, Merryn Somerset Webb. It was produced by Samir Sadi, production support and sound design by Moses Andem, and special thanks to Lawrence McDonald. And be sure to follow me and John on Twitter. I'm on Merryn SW and John is at John_Stepek. And don't forget to keep reading that award-winning newsletter, which is not taking August off. You're not taking August off, are you, John?
Or maybe a week.
Maybe a week, okay.